Let's talk about Japan, not as the land of the rising sun, but as a nation staring into the eye of an economic storm. Of all the G7 countries, Japan might be facing the most critical moment in decades. At the center of the chaos, a debt mountain so high it scrapes the edge of financial reason, over 260% of GDP. That's not just unsustainable, it's apocalyptic. And when that bubble bursts, there's no backstop, no soft landing, just collapse. But the pressure doesn't end there. Across the Pacific, another threat looms, a brutal tariff standoff with the United States. Trump's proposed auto tariffs are not just a policy debate. They are an existential threat to Japan's biggest industry. In just 2 months, Toyota alone has taken $1 billion hit, and it won't be the last. Japanese automakers, once untouchable giants, are now staggering under the weight of their dependence on the American market. And now, that market is cracking. If you're in Tokyo, your gaze is fixed entirely on survival. The debt crisis? There's no fixing that today. But the trade war? That's bleeding now. And if it's not cauterized fast, the entire economy could seize. Unlike China, Japan doesn't have time to strategize, delay, or wait it out. It must move, and move now. The latest GDP data? Grim. Japan's economy contracted by 0.2% in Q1, now officially revised downward. That was before the tariff shocks of April. Q2 is likely to fall again, confirming recession. For a country that thrives on exports, that is an existential threat. You recover from recession by selling to the world. But what if the world doesn't want to buy? Even the Bank of Japan is paralyzed. They can't raise rates. Industries are already teetering on the edge. Higher borrowing costs could be the final push off the cliff. This is why Tokyo is scrambling, desperate to secure a deal even before the G7 summit. They're not negotiating from strength. Unlike the EU or China, Japan has no economic leverage left. And here's where the nightmare deepens. Japan must keep exports affordable globally, but Washington has other plans. The U.S. Treasury is now pushing Japan to hike rates, to tighten further, claiming inflation is too high and the yen is too weak. On the surface, it sounds like a prescription for economic health. But peel back the logic, and the real motive reveals itself. The U.S. wants Japan to kill its own export power to boost American competitiveness. That's the trap. If Japan strengthens the yen too much, its exports die. If it doesn't, Washington keeps turning the screws. According to Deutsche Bank, if the U.S. truly wants to erase its global trade deficit, it would need to weaken the dollar by an insane 40%. The dollar has already fallen by 10%. So what's next? Another 20%? 30%? If that happens, the global financial system may not survive the shock. We're talking Weimar Germany-style collapse. But does the U.S. have a point? Japan does have an inflation problem, worse than any other G7 country, even the U.S., and it's crushing domestic consumption. Households just aren't spending. Strengthening the yen could make imports cheaper, easing inflation, but it's not that simple. Even with a stronger yen since July 2024, household spending in March was still down by 0.1%. The economy is seizing up. People don't spend when the horizon is nothing but gray. The Bank of Japan knows this. That's why they're holding off on rate hikes. First, exports must recover. Only then can they afford to fight inflation by tightening. It's a delicate sequence, and Washington is demanding they skip steps. Japan's own Norinchukin Bank sees it clearly. You can't stimulate consumer spending when external demand is collapsing. There's no link between higher wages and inflation in Japan's case. Structural dysfunction runs deep. The safest escape route? Remove the tariffs. But will Washington allow it? Even U.S. officials have admitted this fight isn't just about reciprocity. It's about geopolitical leverage, global dominance, and containment. Japan is being asked, no, ordered, to choose. Crush your own economy to support America's trade war with China, or face the consequences. And here's the million-dollar question. Will Japan comply? Will they sabotage their own recovery to satisfy Washington's agenda? Will the BOJ sacrifice internal stability so U.S. exports can thrive? Japan is trapped in a no-win game, pinned between a fiscal time bomb and a foreign policy vice. Time is running out. I find it hard to believe, nearly impossible really, that the latest negotiations with Japan could go anywhere productive. Even the so-called dream team couldn't agree amongst themselves. Lanique, Besset, Guerre. Each one at odds with the other, openly contradicting, stepping on each other's lines. That's how fractured the American delegation has become. At one point, they reportedly halted the talks altogether, not because of Japan's resistance, but to settle their own internal disputes. It wasn't diplomacy, it was a scramble for credit. Each one desperate to be the favorite in Trump's eyes. And now, astonishingly, that very same team is headed to London to handle the talks with China. Time isn't a luxury Japan can afford. They can't sit around waiting for Washington and Beijing to figure out who's in charge or whether they even want a deal. These talks could stretch on for weeks, maybe months, if they don't implode entirely. So Tokyo is getting creative, or maybe desperate. Lawmakers are weighing whether to weaponize the Trans-Pacific Partnership by expanding it, including China, including Taiwan. A shot across the bow to remind the U.S. that Japan doesn't have to play by their script. Will it work? That's the question. Trump is unpredictable, mercurial in a way that even his inner circle struggles to contain. And this Trump isn't the same Trump from the first term. If he's set on reshoring steel and auto production, there's very little Japan, or anyone else, can say to change that direction. But currency? That's where things turn colder. Much colder. Japan's own economy is wobbling under the weight of its bond market. Interest rates are spiraling upward. The Bank of Japan, trapped by over a decade of yield curve control and relentless bond buying, is now being forced into painful decisions. Since December 2024, they've been offloading their holdings, net, but now even that pace is slowing. Why? Because their system is showing cracks. They're downshifting bond sales to just 200 billion yen per quarter. Proof that the bond market still needs support. When you manipulate yields for too long, you eventually corner yourself. Something always breaks, and if you think that's troubling, look at the U.S. The reckoning is coming, and it's not creeping anymore. It's accelerating. Just follow the Treasury auctions. Around the world, investors are growing visibly reluctant to keep lending Washington money. The trust is gone. Fiscal discipline is a fantasy. U.S. policymakers are still spending like the tab doesn't exist. And it doesn't seem to matter who's sent to put on the face of control. Lanique, Bessett, or now Mike Johnson. None of them are convincing anyone that this isn't a runaway train. Just listen to the doublespeak. This isn't going to add to the deficit. It is. It isn't. The CBO says it will. We're cutting $1.6 trillion in spending. Debt's still rising. It's incoherent, but that doesn't stop the bill from moving forward. Trump controls the narrative, and the result is clear: more debt. Credible forecasts show that this plan could balloon the national debt by another $2.4 trillion. Why? Because Trump is betting that $2.6 trillion in added debt will buy a modest 0.8% GDP boost and maybe 1 million jobs. That's the strategy. Borrow from the future, gamble on today. Tax cuts to counterbalance tariffs. Growth to mask the pain. It's a bet that could work on paper. But only if two massive assumptions hold true. Industries must actually come back to America, and bond yields must not rise. Not even a little. If either piece fails, the entire plan implodes. And we're already at the edge. This week's Treasury auction will be a crucible. Bessett is set to sell $22 billion in 30-year bonds. That's not just a routine issuance. It's a global stress test. If it fails, if investors balk, it'll be a clear message. The world is no longer willing to fund America's fantasy. It won't be ambiguous. It'll be a rebuke, a rejection, a signal that U.S. inflation is now viewed as structural, and that the fiscal madness isn't temporary. It's systemic. Just think about it. Lending money to the U.S. for 30 years at 5%, under the assumption that long-term inflation will remain under control? That's not belief. That's delusion. And if foreign demand falters, if they pull back from the auction, it's not just a bond market problem. It's a currency crisis. Because when foreign buyers pull out, they're not just rejecting bonds. They're rejecting the dollar. In the last auction, domestic buyers were already backing off. Only 14% participation compared to a 17% average. That was inflation fear. But if the international buyers now start heading for the exits, it means they no longer believe in the dollar's long-term value. That's a much deeper problem. And unlike short-term yields, the Federal Reserve has no real power over long-dated bonds. This is pure market mechanics now. Brutal supply and demand. If Trump pushes forward with his reshoring agenda, it will mean upending the entire global trade architecture. The U.S. current account deficit, still sitting at an eye-watering minus 3.8% of GDP, would need to swing to balance. That requires a monumental shift. Americans would have to buy more domestic goods and import less. Global dollars would dry up. Exporters would earn less and have fewer reserves to plow back into U.S. assets. And here's the twist of irony. Trump wants to sever the world's dependence on the U.S., but he still needs the world to keep buying in. If they don't, the consequences will be swift and unforgiving. So the question now is, will Japan continue playing along? And will global investors give U.S. debt one more chance? Or have they seen enough? Let me know what you think. Stay safe. These aren't just volatile times, they're historic.